Happy Friday, everybody. In place of a typical podcast, we're going to be doing a screencast today, considering how poorly the stocks in the stock market, and I say it that way purposely, because the stocks in the stock market have been doing so poorly, because we are right in the thick of the seasonally weak months of the year, because there's a lot of worries about inflation, tapering from the standpoint of stimulus interest rates, whether or not the stimulus bill is going to pass next month, what's going on at Jackson Hole. There is a lot of, we're getting emails, we're having people in our office that are really, really concerned, and so I felt it was a good time to do another, what I call, Inside the Huddle update, where instead of doing a podcast, we're doing a screencast. I'm going to go through a ton of information very quickly. You can hit the pause button, rewind, go back. If you have any questions at all about any of the information that I'm going to share today, then please feel free to email me personally. Reach out to us at info@libertaswealth.com if you have any interest in setting up an appointment, a phone appointment, Zoom call. If you'd like to get set up a second opinion appointment or go through our second opinion process, same thing, info@libertaswealth.com. Or if you'd like to go to our website, there's a place where you can set up an intro call right on our contact page, and you'll get access to our calendar that way. But let's go ahead and just jump right into it. Like I said, there's a lot to go over here. I love quotes. So the quote of the day, the averages are merely the backdrop of the game. The real contests are waged over the stocks themselves. And that goes back to what I said earlier. There's the stock market, which most people think the Dow, the S&P, the Nasdaq, the NYSE, the Amex. So those are the averages or the major market indices. So when Justin Mamis, who is a market technician and an author of several books, when he said the averages are merely the backdrop of the game, it just means that it's just the backdrop. It's a snapshot at what maybe a oncologist might look at his or her patient and they might see, this is the backdrop, this is my patient, I'm looking at them from the outside and they look fine. But when you look inside and when you go into the PET scan and you look at x-rays and you start seeing what's inside the market, in this case, for this analogy, then what you start seeing is there's something going on under the surface that maybe isn't so healthy after all. And we're living, like I said, in the middle of the seasonally weakest months of the year for the market. May 1st through Halloween is the weakest time of the year, the seasonally weak 6 months of the year. But we also are now in the middle of August, and August and September are the worst 2 months for the market on average. It just takes being a little bit patient, getting through this time period, and then kind of seeing how things come out on the other side. So, a couple things I wanted to share with you I got from Guggenheim. I thought this was really interesting. The recovery in COVID-sensitive activities is starting to stall, and it's likely due to the Delta variant. So you're starting to see here, since pretty much the end of June, beginning of July, we're seeing a decline in the number of restaurant diners. We're seeing a decline in the number of travelers through TSA checkpoints. So that's one thing that's a concern. And of course, the big concern really behind all that is whether or not the the Delta variant is going to affect the market in a big way, in the economy, I should say, or if it's just going to be a blip on the radar, and we just don't know yet. And then Guggenheim also put this chart out where the expected gross domestic product or expected GDP impact of COVID over the next 12 months. And you can see here that it's the tail end of this chart's not all that positive. So that's another, again, big concern that people are focused on right now is how is this Delta variant, and then, of course, behind the Delta variants, the Lambda variant, how is this going to affect the economy, especially as we start moving into the winter months. When we move back to stocks, this is a chart of the S&P 500, which looks beautiful. Let's go back to that oncology example. The oncologist and his or her patient, they look good on the surface, but when we look at the PET scan down on the bottom here, only 56% of stocks in the S&P. So there's 505 stocks in the S&P 500. The index is going up because the biggest stocks, and it's a small handful of big stocks, are carrying all the weight and making it look better than it is, all while only 56% of stocks inside the S&P are above their 50-day moving average. If we move on to the NYSE, this is the NYSE Composite, which is almost everything you can trade on the market right now. Again, a nice chart upward for the most part, with the exception since June, it's pretty much sideways. But when you look down in the bottom here, again, this is the percentage of issues, in other words, investments inside the NYSE Composite that are trading above or that are above their 50-day moving average or 50-day trend line. The 50-day trend line, to give you an idea, that's the blue shaded area here. That's what I call being above water or underwater. When we look at the NYSE Composite, technically it's kind of treading above water here, just barely. It's taking a couple dips below water. But what the line below is it's saying the percentage of stocks that are below this blue shaded area, or other words, underwater, which would be their intermediate term trend line. So only 35% of stocks in the NYSE are above this blue shaded area, or said another way, 65% of them are below it, which obviously doesn't say a whole lot for the health, the internal health of the market itself. Let's move on to the Nasdaq. This is the Nasdaq, which is the Nasdaq Composite is comprised of a lot of growth stocks, the kind of stuff that did well on the last half of last year once we started coming out of COVID. What we've seen since pretty much February is a flat line for the most part. Maybe we're up just a tad since February, but when we look at the percentage of stocks inside the Nasdaq that are above their respective 50-day trend lines, 50-day moving average, or intermediate term trends, 27% of them are above it, or in other words, we're looking at 73% of stocks are below or underwater their 50-day trend line. So that's obviously not good. My good friend, very good friend, Andrew Thrasher, he put this chart out. He pointed out, again, this is the S&P in the top. This is the percentage of stocks in the S&P 500 that are down more than 10%. And we can see here that on the S&P, almost 30% of stocks inside the market are down more than 10%. Never mind being down, period. We're saying over almost 30% of stocks are down more than 10%. And then 7 and almost 8% of stocks are down more than 20% inside the S&P. Another good friend of mine, Ian McMillan, over at Adaptive, he put this chart out, which I thought was, on one hand, fascinating, on the same hand, frustrating to look at, frankly. But here is two stocks on this chart. You've got Amazon, which going back to the beginning of the year is down 0.5% as of the time that this chart was snapshot. And then you've got Dillards, which is up 208%. Now, I don't know about you guys, but where I grew up in Northwest Ohio, Cleveland area, I don't even know if there's a Dillards up there anymore. If there is, you can let me know. Shoot me an email, leave it in the comments section, and let me know if I'm wrong here. But where I live in Northwest Columbus, they turned Macy's into an indoor amusement park with video games, roller coasters, bumper cars, laser mazes, and laser tag. So when you look at this chart, and Ian, what he put on his caption for this chart, which I didn't include, by the way, his caption was, "Investing is hard." And the point is that what are the chances that year to date we would have a stock like Dillard's, which is up so much? We're talking a big box retail store where you buy clothes and stuff, versus an Amazon where everyone is shopping these days online. It's like Christmas every day at everyone's home, right? And it's down year to date. So that's the kind of market we're living in right now. The next one thing I wanted to show you is a relative rotation graph. This is Julius de Campaneer's brainchild here, I'll say. The upper left-hand quadrant is improving versus the market. Upper right is beating the market. Bottom right is weakening versus the market. Lower left quadrant is lagging the market, or losing or underperforming the market. The market would be the 0 point of the XY axis here. And I want you to try and ignore the mess. Let me walk you through this here, but I want to point out a couple things. First of all, I want to point out that there's only a couple investment sectors or industry groups that are actually doing well, healthcare being one of them, lithium stocks being another one, but everything else for the most part, and I don't want to say everything else, I don't want to generalize, but most other stocks, industry groups, sectors are either weakening or heading towards weakening. This is steel, master limited partnerships, materials, oil and exploration, uranium stocks, small cap energy. Then you've got blockchain over here, which is underperforming the market. It's trying to get into an improving quadrant. It's trying to get some traction, but it just can't. Here's marijuana stocks. which are just, sucking wind. They're just not doing anything, no pun intended. Biotech, some of the biotech stocks like XBI here, it was trying to improve and then it turned around, rolled over, and now it's starting to underperform again. IBB, which is a bigger index that we technically own in our portfolios. And by the way, we own TAN, which is the solar stock index. We own ARC, which is Kathy Wood's technology index, as well as ARCG, which is her genomics index. We own those three, and while TAN is hanging in there, the solar stocks are hanging in there. We're starting to see right now the ARC technology and genomics funds starting to roll over, and these stocks are just struggling again. So we're starting to see things kind of struggle. What we're seeing is we're seeing things struggle to outperform at all or even improve. And when these things start to improve, they're just rolling over and struggling more. ARCQ is another one down here that we own. And every one of these dots is 1 week. And because the dots are getting closer and closer together, what that's telling us is momentum is slowing down. So even something like ARCQ, which again we own and things are okay right now, they're on the brink of breaking down. And when I say that, here's what I mean. This blue line right here is the 50-day moving average. It's the call it the 50-day trend line, if you will, intermediate term trend line. You can ignore the dotted line. That's the 21-day moving average. It's a shorter term trend line. But I don't like owning things that are below water or underwater. And right now, this week, it's Thursday. What time is it? 12:16 as I'm recording this. We'll distribute it through email tomorrow. If you're a subscriber, you'll get it right away, obviously. But if this thing can't hold this low back here, because we got higher lows, higher highs, but then we have a higher high right here on the right. We have a low here. If this can't stay above that low and we're underwater, it just doesn't make sense to own this thing anymore. The same thing goes for solar stocks. Solar stocks started to look like they were starting to come around, starting to improve. Just like we were looking at that relative rotation graph a second ago, we got higher highs, higher lows, but now we have a lower high, and here's a low. If this breaks down and cannot make it back above this line in the sand this week, then we've got a lower low and a lower high, which is obviously not good because again we're underwater, so it's a lot of negativity here. Things don't look good. Amazon, here's everybody thinks that Amazon's doing well because we all shop there. I mean, I shop on Amazon constantly for the office, for home. My wife shops on Amazon all the time. Everybody I know has an Amazon subscription and they shop on Amazon. I just bought one of those puddle lights that go on cars. See some of these luxury cars, you open the door and you'll see the logo on the ground, shining on the ground. I just bought one of these little puddle lights for my son to put in his locker at school, so when he opens his locker, it'll shine the Ohio State emblem on the floor. I know, if you're not an Ohio State fan, I apologize, but I think it's pretty cool. But the point I bring that up is I buy almost everything on Amazon. The only time I won't shop online is if I have to buy something like dress clothes that I need to try on. And even then, I know a lot of people that will just buy things online. They'll try them on at home. If they don't fit, send them back. And again, it's free shipping, so who really cares? But anyway, we're looking at Amazon here. Amazon, this is a chart going back to July of last year. We're talking 13 months, more than 13 months. Amazon has gone absolutely nowhere in 13 months, even though it's a great company with great sales and great earnings and great margins. It's just not doing anything. When we look at Netflix, it doesn't look all that different. Go back to July, again, 13, almost 14 months ago. And Netflix is trading at the same place it was 13 months ago. And it's not like we're going to stop watching Netflix. I mean, I feel like we watch Netflix at least once or twice a week. It's not like people are going to start unsubscribing because the economy is starting to open up. And one might argue that, well, with the Delta variant, why isn't this going up? Because they're getting more subscribers. I don't know. Maybe it will keep going up. You can see a low here, a higher low. This is not a higher high if you go back in time. This is just a range that it's bouncing up and down in. So maybe Netflix will start to get some traction, but at least for now, it's been dead money going absolutely nowhere for a really, really long time. Here's Zoom Communications. We use Zoom literally at least twice, 3 times a day. Meeting with clients used to be just all over the country, but now we meet with all of our clients here locally. A lot of Zoom meetings for people who aren't interested in coming in to see us, even though we're vaccinated. Again, Delta variant, you would think that there's so many subscribers to Zoom that it would be performing very well, but what you can see here instead is that it peaked out at around $570 a share in October of last year, and then since then it bottomed out at about $280, we'll call it, and now it's trading about $334, which is the same place it was almost a year ago. Again, same story. If we look at the top 50 growth stocks, Investors Business Daily, their top 50 growth stocks in this country, this year so far, they peaked out in February and it's down since then. So they're not underwater technically speaking, using that 50-day moving average, but it's not good. This is not how a healthy market looks if we're looking at the top 50 growth stocks in this country. If we look at small cap stocks, so this is small companies. So small cap stocks keep kind of riding this line right here. If you follow my mouse, there's a low here in March, there's a low here in May, another low in July, and the market seems to keep bouncing off that low while at the same time bouncing off this, call it 228 to 230 level on the top side, call it 231, 232. So it's also in a range. It's up, down, up, down, up, down, kind of between, call it 210 and I'll just say 235. And what should happen with small caps, what should happen with these smaller companies, these which are a lot of the growth and technology companies, is because the prior trend was up before this, it should continue up. So it should digest sideways and it should continue higher. However, every time we touch this lower level here, there's a higher probability it breaks down as well. So if we break down from here, that would be really bad for the market. It would not be good. So that would be negative evidence, we'll call it. Then we look at gold. So we might think, well, if stocks are struggling so much, then maybe things like gold are doing well. Well, look, here's gold. Gold, going back to July of last year, peaked out at about $194 a share. This is the GLD ETF, and now it's trading at 166. It started to look like it was turning around here. We started to see some traction in May, and then after that, it just kind of the bottom fell out, a trapdoor below our feet, metaphorically speaking here. We get a low, we get a lower high, and we have another lower low. And right now, this is a downtrend as far as I'm concerned. We're underwater, below our 50-day moving average with lower lows and lower highs. And I think that our floor, so to speak, if for maybe gamblers out there that wanted to look at 157 as a potential line in the sand, that would be another trapdoor that hopefully holds. But if it doesn't, if we break below 157 on GLD, I think all bets are off here. What is working though? Well, what's working? Not a whole lot. It doesn't seem that way. That's for sure. One thing that is working is bonds, 20-year treasuries, long-term corporates. This is the 20-year treasury, which bottomed out in March. And then since then we had a higher low, and then a higher high. And since then, I don't want to say we've been off to the races. And also keep in mind, this is not a stock, so it doesn't move nearly as fast as a stock does. A bond's going to be much slower. The increments on the right-hand scale over here are going to be smaller. So it's not like we're looking at 10, 15, 20% gains here. What we're looking at is smaller gains, but gains nonetheless. So what's working right now, bonds are working. Another thing that's working right now are what are called Treasury inflation-protected securities. Pretty much almost all year, TIPS for short, Treasury inflation-protected securities have been doing well and continue to do well for obvious reasons, with inflation being such a concern right now. When I look at my pre-flight checklist, when I look at my snapshot every day, I open this up and take a look at what the trends are right now. Short-term trends in the market on the S&P and the Nasdaq are starting to break down. Intermediate term trends are kind of shaky, but positive, at least on the brink of turning negative. All the long-term trends are still intact, and I guess that's the saving grace, is that as long as the long-term trends stay intact, and as long as we can get through this next 2 months, again, August and September are the worst months for the market, seasonally speaking. So as long as we can get through these 2 months without too much downside and without any geopolitical things happening, without anything happening with COVID and the Delta variant, as long as Jerome Powell and the Fed doesn't do anything crazy when it comes to tapering, things of that nature. I just looked over at my screen here. I thought I saw Jerome Powell on the TV and he wasn't there. But anyway, but when we look at is it safe for new entries right now, the answer is almost unequivocally no. Is the market climate positive? I would say it's leaning negative. There's other research that I subscribe to as well, and a lot of the things that I'm seeing out there are not positive. So at least for the short term, intermediate term, I think it makes sense to be a little bit more defensive. That doesn't mean sell all your stocks and go to the basement. What that means is just, for us anyway, we're looking at lightening up positions. We're looking at, raising cash levels just a little bit, not too extremely, but a little bit, and then kind of seeing how things go from there. Now, I keep talking about seasonality, and when I talk about seasonality, what I mean is that the seasonally strong months of the year are the months between November 1st and April 30th. So those are the strongest, on average, the strongest months of the year for the stock market. The weakest months for the year are between May 1st and Halloween. If you've ever heard the phrase sell in May and go away, that's where it came from. It came from Jeff Hirsch over at Stock Traders Almanac, and this is data I just pulled from Dorsey Wright. But this is a chart you're looking at here, and this is the growth of $10,000 in the Dow going back to 1950 through April of this year. And what you're looking at is it's not an illusion, it's not a mirage, it's not a trick. It's $10,000 invested during the seasonally weak months would be worth about the same amount as it is today, as it was then, 70 years ago. So in 70 years, if you invested $10,000 on May 1st and you sold out of the Dow on Halloween every single year and went to cash for the winter months, then you would have $10,000 roughly. If you invested that same $10,000 on November 1st and you sold on May 1st every single year, going back to 1950, then that $10,000 will be worth more than $1 million. And just to kind of scan down, first of all, if you want to hit pause and let that sink in for a second, that's one of the reasons why we have to be patient and through this time period in the summertime. And I'm sure I'll get some emails that say, well, why don't we just sell everything? Why don't investors just sell everything and go to cash in the summertime? And the answer is, well, this is just the Dow and it's just the S&P. And that's the theme for this screencast. And really why I wanted to record this today is because just because the market, just because the generals, the big, huge mega cap stocks are going up, and not all of them, by the way. I showed you Netflix. I showed you Amazon. Now, Facebook's going up. Google's going up. Microsoft's going up. Apple's kind of on the brink of struggling, but it's been going up. Those are the big stocks that are carrying the market up. And because they're so huge, and because the S&P 500 is a cap-weighted index, that's making the market as a whole look like it's going up. But when inside the market, a lot of stocks are going down. And what we want to do is we don't want to just sell everything, and because we're looking at the Dow here, we don't want to just sell everything and go straight to cash every summer, because there's always lots of opportunities throughout the year, and we never know when they arise, and we never know when a trend takes place and we start to get traction until it obviously starts to happen first. But it wouldn't pay just to use history and one statistic like this as a guide for investing going forward. So I just wanted to make sure I disclose that up front, just in case any of you are thinking it. When we look at August specifically, obviously it's already August 19th today. The average return for the Dow in August, going back to 1950, is down 1.7%. In fact, it's the worst month for the Dow. It's the second worst month. Again, August is number 2. September is the worst, obviously. Down 1.4% on average for the S&P. The Nasdaq's down 1.2 on average, and the Russell, the small cap index, they're down 1.4 and 0.8% respectively. When we pick that apart, when we pick apart that graph I just showed you, a few things. Since April 30th of 2000, the Dow has gained 216%, but again, it's only up 10% during the seasonally weak periods between May 1st and Halloween. During the seasonally weak period, again, May 1st to Halloween, 24 out of the last 71 years were actually down in value, while there were only 15 years during the seasonally strong period of time that were down. There have only been 3 years when the seasonally strong months, that's the months between November 1st and April 30th, there's only been 3 years during the seasonally strong months that lost more than 10%. And that was 1969, 1973, and then 2008. And obviously, for those of us who were investors back in the 2000s, pretty easy to remember 2008, because obviously that was a huge crash, 18 months long, 57, almost 58% drawdown, and 2008 was the last big drawdown of 10% or more during the seasonally strong months when things were just falling apart and the sky was falling. And the seasonally weak months have seen losses of 10% or more 11 times. There's been 16 times since 1980 where the seasonally strong months of the year have posted a double-digit positive return, with 6 of those 16 being more than 20%, or in other words, up more than 20%, 6 out of those 16 times. And then, since November of 2009, the Dow has experienced a streak of 4 consecutive positive double-digit returns during the 6-month period, and that's the second longest streak in history. The other one, the strongest time period ever in history, was in 1994 during the biggest, best bull market ever in 1994, and it lasted 5 years. So the last thing I want to show you today is I showed you this last time in July when I pulled up the seasonality charts. This is a chart that basically shows us a first-year Democratic president versus a post-election year after an incumbent party lost, and these numbers are drastically different. If we look at a first year of Democrats in office, you can see the average return for the S&P ends up being up about 10% on average. But if we look at a post-election year after the incumbent party loses, which is what happened last year as well, then we can see the market goes nowhere for the first, call it 8 months of the year. Then it goes down about 3%, and then it finishes the year strong, but only up about 2% on average. So what I want you to take from this chart isn't what I think should happen or will happen, because this is just historical statistics. We can't use this like it's the Bible and like it's going to happen going forward exactly this way or that way. What I want you to focus on is the fact that this August and September time period is a very weak period of time, typically, not just for a year when after the incumbent party loses, but also for other years, post-election years in general. You can see here it's generally flat during all years from 1949 to 2019. And the only positive number during the seasonally, I'll call it the worst 2 months of the year, August and September, are years when there's a first-year Democratic president, and that's the average. But then we again, in all these cases, when we hit October, we start to see a strong fourth quarter, which is what I'm hoping for. It's what I'm expecting. I keep saying over and over again that the Fed is on our side. We do have stimulus around the corner. Assuming it passes, that would be a boost. I don't see the Fed, especially if the Delta variant becomes an issue. I don't see the Fed backing down anytime soon, and I don't see them starting to taper too prematurely. I think that would be a bad idea. Of course, we could see them reverse course. We saw that happen in 2018, first quarter of 2019. So anything can happen here, obviously. We just have to be paying attention, and we have to allocate our portfolios accordingly. If you're a younger and or strategic long-term buy and hold investor, then your buy and hold models, like the ones we manage here, are going to stay in the market, and they're going to rotate to more defensive names if this defensive posture stays this way. If we start to see a continued momentum to the downside, then we're going to see a rotation out of the offensive names like technology into more defensive names like utilities and blue chips. If you're in our tactical model portfolios, again, like I mentioned earlier, we're starting to get a little bit defensive here. When I say a little, we've raised a little bit of cash so far, but as time goes on this next few weeks, if things don't get better, we may be taking our foot off the gas a little bit more. But I want to reiterate, I don't see a market crash coming right now. Will we have a market crash again someday? Yes, absolutely, 100%. Of course, it's inevitable. It's not a matter of if, it's when. But market crashes don't happen overnight. Nobody goes to bed on Friday and wakes up on Monday morning and your portfolio's down or the market's down 50%. It just doesn't work that way. COVID was pretty close. Black Monday was a rough time. Most people don't realize that Black Monday that year, 1987, the market actually ended positive that year, believe it or not. But that's where I'm going to end for the day. Again, if you have any questions, feel free to reach out to us at info@libertaswealth.com. If you want to follow us on Facebook at facebook.com/libertaswealth. I'm on Twitter at Adam Koch. We're on Twitter as a company at Libertas WM. I'm on Instagram at Financial Surgeon. If you'd like to set up an appointment, if you have any questions at all, phone appointments, no obligation, obviously. If you just want to chat, you can reach out to us via, again, email or online at our contact page. You can get access to our calendar there. But thank you so much for taking the time to watch, and I will look forward to hearing from you soon.